go. And so let's kick it off. If I could have the next slide, please. So there's me and Rebecca. We'll go over to the next slide, please. And as always as well, if I could please ask for you, I know that we always get lots of shout outs over social media. And if you do decide to take any screenshots or share that, absolutely great. Here are the social media handles for UN Women, NAMA Women Advancement Establishment, also for Rebecca and the company that she works with, Mindshift Capital, and also for myself. So please, it would be really great if you would tag everybody when you do your social media posts as well. We can have the next slide, please. Now, tiny bit of housekeeping today, and this is one event that we wanted to share with you, that it's being put on by UN Women's partner Shira, and in Sharjah on the 22nd to the 23rd of November, there is going to be the Sharjah Entrepreneurship Festival. The website for that is on the page here. It's sharjahef.com, and if you take a look at their website, the content of this program looks phenomenal. So if you're able to get down for 1 or 2 days of this event, it looks great. It's free of charge as well to attend and for you to register. So do have a look on their website and see if you can get down there to join them as well. Okay, if we could have the next slide, please. So before we get started, as we do with all of our UN Women sessions, is I would be really grateful if you could just fill in a very quick poll for us. And the first poll is, we would really like to know from you how much knowledge you have about funding and investment. And this will really help those of us at UN Women and NAMA Women Advancement Establishment to understand how we've been doing at meeting your requirements for what you need to know in this area. So while you're doing that as well, we have one more poll. So we're going to kick off this morning with lots and lots of polls. So if I could ask you quickly to fill this one in first, because it is quite important for us to have an understanding about where you are. We're at about 68%. So the quicker you fill this in, the quicker that we can move on to the next slide, please. There's about 20 more people that need to fill it in. It's just popped up on your screen. If you could fill that in for us really quickly, please, that would be fantastic. Now, one other poll that we have, and this is for us to really benchmark the session today. If we could go to the next slide, you're going to have another poll that's going to pop up on your screen in a second. If we could just move that over to the next slide, please. So what we would like to know, we're going to have a couple of polls come up. I'm going to quickly end this poll right now and pull up the next poll for you, which is going to be to ask you all of these questions. So we would really like to know if you're running your own business or intending to start one. So just for us to be able to benchmark and see where you are at this moment. And also we'd want to know as well is if you've invested in a business other than your own. And if you have, if it's been a rewarding experience. So whilst you're filling all of that in, I would like to bring Rebecca on and introduce her to you and ask Rebecca to just introduce herself. I'm so pleased that Rebecca has been able to join us, because Rebecca is probably one of the foremost experts on this area, and her specialization is very much in women and supporting women in business. So Rebecca, I'm going to hand it over to you to introduce yourself, and we'll kick the session off.
Thank you, Jen, and it's wonderful to be with you and everybody on the call today. So my name's Rebecca Hall. I'm originally Australian. I'm working with Mindshift Capital. Mindshift Capital is the only Middle East-based gender lens VC fund, venture capital fund, and that means that we invest in the most extraordinary businesses that are led by women and their teams, their diverse teams, across the world, where primarily at the moment the portfolio is around 50% in the MENA region, 50% in the US. We're also actively, we have one investment in Asia. We are about to close our first fund, so it's very exciting. In addition to Mindshift, previous to that, I worked at a management consulting firm for a decade, and I've been running an investment portfolio for one of the largest family conglomerates in Saudi. very diversified, and it was across MENA. And I also advise startups and see everything from investors to CEOs and founders on how to deliver value through their business, and really by trying to challenge the way they think about it and drive future growth and value. So that's me. Great to be here.
Excellent. And Rebecca, we just had the poll, which is finished here. So let's have a look at this. So we have about 55% of women who are running their own business and 37% who are intending to start their own. And then we have 5 who have no intention of running their own business and probably are just here for their own knowledge. And we have about 19% who have invested in a business other than their own. And it's kind of split in their response. 18% said that it was rewarding, 10% said that it wasn't rewarding for them.
Okay, it's interesting. I mean, I think it's really interesting just to set the ground to start off with. I also looked at just understanding that the majority of people have some knowledge of funding their business. Some people are deeply aware and understand it well, and others are starting out. So I think the interesting thing about this, and what I wanted to do here and before we start, is really just to set the context. We will start here around how do you think about funding your business, and really what are the basics that we need to get right at the beginning to make it easier throughout the process. I think there's another really interesting question around why you want to seek external funding for your business and the timing of that. And then we'll talk a little bit around at the very end the process of what it means to go through a investor attraction, if you like. Now, there's there is more information around this, and we can always share that follow up. And please ask your questions, interrupt, share your stories, because this is how we get better at this. And also, it is difficult to navigate. Some of it can seem very straightforward, but when you're in it and running your own business or starting your own business and not quite sure what to prioritize or who to ask, and sometimes you get it wrong. Sometimes we all get it wrong, and so that's just about it's just about how you recover from those situations. So let's make sure that it's interactive. So Jen, should we run the next poll as well, or?
They'll run together, Rebecca.
Oh, sorry.
So you can just pop on and start everything now.
Okay, great, perfect. So today I really want to talk to you about what is an investment-ready business. And there are various definitions of this, but really what it means is that third parties, be it investors, individuals or other equity providers, banks or other capital providers, and these can be governments, it can be accelerators, it can be grants, philanthropic, these sorts of things, are willing to invest or provide capital to your business. That's the first step. The second step is that you are able to secure this funding for your business successfully. And that's how you know that you have an investment-ready business. And we'll talk about a little bit around how you get to being prepared for that process and then hopefully successfully execute it. There's a question around why do you want an investment-ready business? Even if you're saying to yourself, look, I don't think I'm ever going to seek any investment. So why do I need to bother with this? Well, I would argue that it's for 3 main reasons. And there are others, but 3 main. First of all, it makes good business sense. Second of all, it keeps your options open. So you may think right now, I don't need external financing. I'm never going to go out and seek investment or debt financing from anyone, but you don't know what the future will bring. So by setting this up at the beginning, it means you have options. And thirdly, that optionality prepares you for all eventualities. The reality is that as we don't know what will come in the future, despite our best laid plans, what we want to be is very well prepared to do 2 things. 1, to seize opportunities as they come along, and 2, be prepared for the worst. The worst situation is that when you have spent potentially years of your time, your energy, and your life building a business, and something unfortunate happens. It could be COVID. It could be some other macroeconomic thing. It could be a change in regulation, or it could be an illness or some change in your personal circumstance that means that you have to make a change to the way your business is funded or owned. And if you haven't done the work in the past, if you don't have the platform, it puts you under incredible pressure. It means that any funding event or sale event will not be on your terms, and you will be disadvantaged. And ultimately, the business will be damaged and you will end up worse off. So don't allow yourself to be caught in that situation. It's really easy, and big companies do this. So this is not unique to small business owners. When the going is good, people tend not to focus on some of the basics. So let's make sure we don't do that. In addition, at some point, all businesses will need additional investment to grow, and it might even be your own investment. So we all have options in our lives. And when you are faced with the question around growing your business, even if it's your own funds, there is an opportunity cost to that. So preparing your business to understand the trade-offs between putting additional investment into your business or another business, or using that capital for something else is really important. Why does it make good business sense? What does this deliver to your business on an ongoing basis? It will make sure that you and your team are very clear on what your business does. What's your value proposition? What's your target market? And it will focus the entire team on realizing that vision. By doing that, you will ensure internally that you allocate your resources to the things that really matter and deliver the value proposition. And when I say resources in a small business is not about money necessarily. This is about your time. The most valuable thing is management time. And I've seen this a lot. If I go to the other end of the spectrum and I look at a very large diversified investment portfolio, if you don't understand where the value comes in your investment portfolio, and if you don't understand where you want to focus and where you want to be in 5 years' time, you will spend your time and your money on things that destroy value. So give yourself the opportunity to be clear what you're going to focus on and get your team behind you and allocate your time and all your other resources in the places that make the biggest impact. And lastly, but I think probably almost most importantly, other than being clear on what your value proposition is, the performance of your business and your cash management will be transparent and actively managed. We'll talk about at the end around why businesses fail. But not understanding the cash management is very, very critical. So all of these things are just good business practices, and they'll set you up for success in the future. And as I said, overall, you'll perform better. Secondly, it keeps your options open. It gives you flexibility and options to different types of funding based on the need of your business. It can be once you realize that you need money, it's quite difficult to retrofit all of the things that you needed to have in the past. A very good one is if you are seeking debt financing at all, often you need to have audited financials. Okay, that can be it can seem prohibitive and very painful at the beginning of your business, but if you start it off right, it's actually very simple. So you need to do it in the beginning to give you the options in the end. And it's interesting because I think a lot of people, and there's a reason for that, it's hard to secure debt financing very early on. However, if you are able to bootstrap, as they say, your business through to cash flow positivity and you want financing for growth, debt is a cheaper way to finance your business than taking on other people's equity, and it enables you to maintain control. But we'll talk a bit about that later. But the point of the story is that it gives you the flexibility to look at different types of capital through the journey of your business. It then gives you the optionality to call on them when you need them. And this can be very opportunistic. So there could be an opportunity to buy if you're running a restaurant, you might want to expand to a new location that's just become available, and you really want that location, but you need to snap it up. It could be that there's another small business that you want to merge with. It could be a range of different things. If you don't have the access to the funding, you can't call on it when you need it. It gives you flexibility on your future capital structure, which I talked about before. And this is really, your capital structure is really how your business is financed. And it's whether it's debt or equity. And this is actually how very sophisticated investors really optimize their returns. They look at this capital structure question, but even on a very small business basis, it's important to understand what's the trade-off between taking debt financing and equity financing and how that affects the ownership structure and other things. And lastly, you will get better terms and conditions on all of your financing if your business is well positioned and is investment ready. Again, if you are less investment ready and you are looking for debt, you'll be penalized by the interest rate. Either you won't get it, but if you do, you will be higher risk. And lenders know this, so they charge higher interest rates. If you are asking for equity, they will see that the risk of your business is higher. So your valuation will be lower, or they will take more of the business, or both. So you will not have the same sort of terms and conditions if your business is not as investment ready. And I talked briefly around all eventualities: weathering a downturn, a quick and efficient sale process if needed. And again, it goes back to the terms. You will secure the best pricing in any transaction event that happens if you are well prepared. Okay, so that's all very nice, but what does it mean? What is investment ready for my business, and how do I do that? As you're looking at getting investment ready, I think there are 3 questions that we ask, and 2 are very important to understand before you. Well, it's not before, I think it's in parallel, but they are 2 questions that I would like us to talk a little bit around before you get into a conversation with anybody about taking investment for your business. And lastly, then we'll talk.
Sorry.
Yeah, hi.
Hi.
Hi, Adam.
Can we have an access to record this, please?
Yeah, sorry, Adna, it is being recorded. If you could just please put things in the chat rather than interrupting, please.
Mm-hmm.
Thank you.
Shukran.
So first of all, ask yourself, what type of investment? Am I aware of what the types of investments are, and what type of investment do I need, and do I need it? And then the second one is, what type of investor am I thinking about working with? Do I understand the options available to me and how they differ? And then the last thing is, how do I get investment ready, and how does that differ based on the type of investor that I'm thinking about approaching? And then lastly, we'll talk a little bit around what does that mean in terms of documentations and materials, and what does the high level process look like if I'm going through an investment process? Now, there are many other elements to that. Once you are really seriously in an investment process, particularly if you're pitching to what I would call more institutional investors, when you sort of get into the venture capital space. And the market's very hot at the moment, and it's very trendy, I think, but that doesn't mean it's right for your business. And so I'd be happy to have a general conversation about that at the end of this. And please put all your questions in. I'll do my best to respond. So when we talk about investment, there are different types of investment. It can be money, cash. It can be people, human resources and talent. It can be raw materials. So if you've got a manufacturing business or anything, even in a restaurant business, anything where you produce something. And lastly, it can be buildings and equipment. It can be real estate, it can be machinery, it can be a lot of different things. Today, we're going to talk primarily or only about attracting the first type, money, cash. So what kinds of investment, forms of cash contribution are there available in the market today? Some of you may be well aware of this, so bear with me. But sometimes we leave some out. And so I'll talk about this and what are some of the characteristics. So the first thing is personal funds, your savings. It's very straightforward. Hopefully they sit in the bank. You're able to access them. There's no additional cost to securing these other than the potential loss of those savings. And you could argue, if you want to be very technical about it, it's the opportunity cost to you of putting the savings into your business versus putting the savings somewhere else. But the downside is limited to the loss of those savings and I guess of the loss of alternative earnings. You have full control over this, most likely. So this is fully at your discretion. This is the simplest and most straightforward way to fund your business. The second one are grants. Now, grants come in a range of forms, and I would really encourage early startup businesses, early stage businesses to look at how they can access this sort of funding. They can be small business startup grants or other small business programs. They can be research grants. They can be other sort of aligned with government or other industry initiatives. There are also, and it's not on this slide, but there are an increasing number of foundations that provide grants to they are either industry driven or problem driven. So, we'd like to provide grants for people who are working in climate change, or we want to support diverse founders, or we want to support businesses in certain economic areas, be it geography or other. These ones are an application process, most likely. They may come with certain types of restrictions. So what you can use the cash for in terms of actual deployment uses, or restrictions, obviously, in the type of activities. And I'd make a differentiation. So the grants could be grants to fund salaries, grants to X, or it could be grants to do research or deliver a prototype in this area, geography and or sector, or solving a certain problem. Now, you usually have to comply with these restrictions or these criteria, the uses. And the issue where this can become challenging is if something happens or changes, then you may have to repay the money, or there may be other sorts of penalties or catches. The other thing here is that it can come, not usually on the early stage, but as you become bigger, one of the trade-offs that people often have to deal with is the reporting requirements. So, I've seen this a lot also when investment funds take what are investments or grants from large multilateral organizations who are investing to drive economic development or something similar, that the reporting requirements can be very onerous. So just be aware of that. It doesn't happen usually at the small end of the spectrum. It can happen at the bigger end. It doesn't mean don't do it. I think they are a great funding source, particularly because they don't come with the costs associated with it in terms of interest repayments, nor do they come with a shareholding stake in many cases. But be aware that there can be other restrictions or other requirements that you have to meet going forward. Then we get into the ones that people we're probably expecting to talk a bit more about today. The first are loans and credit facilities. And these can range from a friends or family loan. It could be your brother, your sister, your mother, the person next door, your best friend from school. They'll give you a little bit of money on the side and say, hey, pay me back when you're ready. Or maybe you have a more formal arrangement, but often it's less strings attached. Then you get into consumer finance. So your credit cards, an unsecured personal loan, mortgages, and that can be the mortgage on your house. It can be other things. There are peer-to-peer lending platforms, which are increasingly available for businesses to access funding, particularly in the region where banks are still very difficult to secure early stage financing from. The risk and the risk management within the banks really makes this almost very prohibitive. The government is working hard to encourage and to provide sources, but it's not easy. Okay. And then you can have other asset-backed loans where you can either secure that lending. Here we get into things like receivables financing, equipment leasing, a whole lot of other things. Your business tends to need to be more later stage, not fully, but you need to be operating. You need to have some sort of assets that the bank can secure it against. How does this work? It's got repayment terms, obviously, and interest costs, so cost for the funds, plus penalties if you don't meet that. It's usually, other than in case of it's unsecured or credit card, secured against some sort of assets, as I mentioned, and it's based on credit history and track record of business. Not the consumer finance stuff. That's up to you, because again, what you're doing is taking funds and making it personal funds. But be aware there can be significant risk on this if things go wrong. And then you have the one that people talk about a lot in the market at the moment, which is equity financing. This is usually cash, but it can come in the form of other things. So for example, it can come in the form of land or real estate assets as contribution. We talked a bit about other sorts of capital. It can come with technology contribution and other sorts of things. So there are various ways, but we'll talk here primarily about the fact that it's cash. This comes with an ownership stake in the business. There is, you do see a thing called mezzanine finance, which is a hybrid between a loan and an equity stake. It's not yet very big in the region here because of the laws around recourse on the ownership or the assets in the event that it doesn't work, and it's very expensive. Because of that, it's still very expensive. And what it starts off is as a loan, and then it has a clause in it which enables the lender to convert, potentially, given a couple of criteria, into an equity stake and an ownership stake. So it's this hybrid between a loan in the beginning, which converts into equity later. This may come with some sort of controlling rights. Now, when I say controlling rights, I don't mean that they'll necessarily take control of the business. What I mean is they may have some right to have a say, or sit on a board or something similar. And this is based on the sort of typical, pitch, due diligence, and then a valuation at which they will take a certain percentage ownership of the business against the value of the contribution. So these are broadly speaking, the different ways that you can raise cash for your business.
Rebecca, before we go to the next slide, we have some questions. Are you ready for a few questions? Because I think they're related to here.
Yeah.
So the first one is, we've had a few people ask about how they can find out about grants in this region. Are there specific grant providers, or where can they find out that information?
Look, the best thing to do is, I can come back with a few links. The UAE government usually announces a number of these things. So I would look at the international organizations. So the UN, the IFC, and then I would look at UAE government organizations. I would also, where else have I seen them recently? Those are the primary ones for this region. So I would just do a search. I can follow up later on with some more direct ones.
Another question as well about crowdfunding. I'm wanting to know if that's possible.
Yeah, sorry, crowdfunding is also another one. And often that sort of that's an interesting one, because a lot of people do that actually, and I should have put this on there. Yeah, that's a bit different because people tend to kind of prepay for the product. So it works in some cases. There are also platforms where you can take fractional ownership. It's also an option. Absolutely.
Okay. And there's another question that says, are there guidelines about the percentage which is attributed to salaries versus marketing, sales, and product development costs?
This is incredibly difficult to give you a guideline because it depends on the business.
Okay.
It's almost impossible to say from here. I mean, if you're in a manufacturing business versus a service industry, extremely different.
Okay. And one last question is, are investors only looking for unicorns and gazelles? Oh, sorry, it's disappeared because a bunch of other messages have turned up. What returns over time periods are considered attractive? What returns over what time periods are considered attractive?
Let's talk to the returns question when we talk about the investors.
Yeah.
We talk a little bit around that. I mean, everybody's looking for gazelles and unicorns, right? We all hope that's the case, but they're called unicorns theoretically because they're hard to find. So no, I mean, I think that's not, you know, if you're a VC investor, and there's some kind of rules around this where you, in general, in the portfolio that you have, most of the time you have one investment that kind of, the question is, can this company potentially return my whole fund? That's the question that you ask yourself. So it's not, when you say looking for unicorns, yeah, sure. I mean, at a VC institutional level, yes. But as an angel investor, no. Right? It's a bit of a hard question to answer because I think that by nature, everybody wants to find them. Everybody knows that a number of their businesses won't end up to be that. And again, it comes back to who you're asking for money.
Okay.
If you don't think, if your business does not have the ability to rapidly scale, if the market is not massive and you cannot rapidly scale your business, you're not going to secure venture capital funding, but you may secure other types of funding. And that's why let's talk a bit around how you think about funding your business.
Okay. We have lots of other questions and I'll save those until a little bit later as well now.
Okay, great.
Yeah.
So as we get through this, and I think this is, hopefully some of these will either prompt more questions or help inform them. Look, your business changes, and as your business changes, you need and can access different types of funding. Okay. So at the beginning, you start out with a concept. It's an idea. It's a theory, actually, that you can deliver something, a value. You have a value proposition that is going to be valued enough by enough people who will pay for that, that it will create a large and viable business. But it's just an idea. Okay. Then you develop your MVP, your first offer, your minimum viable product. You get it into the marketplace, but you don't have any revenue yet. Okay. So you might still be developing it, or sometimes you've got, particularly you see this in technology businesses, in SaaS businesses, where you've actually got customers who are using it, but they're not paying for it yet. And that's kind of the freemium model. Then you start to have customers. And so in that, you start obviously charging people, creating revenue, iterating. Usually you're still spending more than you're earning. So you're not at cash flow break even. The business doesn't stand on its own. You're using your savings, your reserves to secure the customers and generate the revenue. Then you approach cash flow break even, right? And suddenly you're standing on your own 2 feet. That means that you're no longer spending more than you're earning. And then lastly, you're profitable. And here you're really scaling because you've got the cash and the profits to reinvest in the business and rapidly grow. Now, at each of these different stages, you can use different types of funding, and different types of funding is available. But one thing I would just like to highlight here is, remember, you understand why you need the funding. Okay. Don't put the horse before the cart. I would really encourage you not to do the trap that says, I've got an idea, I need an investor. The longer you can wait until you take on external money, in most cases, the better for you and the better for your business. I quite like this quote from Dave Bailey, who's done a lot of work in the space, where he says, funding is appropriate for products that have some traction in a large market. For the 99% of companies that don't fit this bill, external capital can be a recipe for disaster. If you're at the invention stage, just remember, necessity is the mother of invention, not money. Now, he is talking from the fact that if you are too well funded too early, everybody loses a bit of hunger. You will not use the money as focused way. You will not be as brutal to focus on the things that really matter, and your urgency will be less. It's human nature. So, well, for most people, okay, there's always exceptions, but in general, be careful. Secondly, taking money comes with strings attached. It either costs you money or people expect things from you. And when you do that, that can be more about the expectations than the cost. The cost is something you have to be able to bear. If you cannot afford it, you will end up in trouble. You will end up, in the worst case scenario, the business goes out, you're out of business, okay? In addition, with regards to taking other people's money, you then have obligations. Rightly, they have expectations. That can also be a distraction for you when you are in the early stage of the business. It is most likely you will know the business better than them, but the minute you take their money, even if they agree to be silent and all the rest of it, nothing's for free. So just think about that before you rush to take on external capital. So in addition, money's not available for you. Not the same level of money is available at all the different stages. So in early stages, really it's your personal funds, it's grants, and it's personal credit. Okay, it's consumer finance. And we all know how expensive consumer finance is, particularly in the Middle East. You know, credit card interest is extraordinary. It's extortionate. Personal loans are also expensive. So I'm not saying don't do it. People do it. Everybody does it, but just be aware of what that means. There are options for equity, through incubators, accelerators. Well, they don't really give you cash. What they give you is they give you connections, support, mentoring, etc. And for that, they usually take a stake in your business. You also can do very early stage angel investing, or as we said before, friends and family. They are there. Usually though, angels will not invest at concept stage. They'll invest at pre-revenue. So you usually still have something that they're investing in. Okay, so early stages, really it's you, it's grants, and it's very friendly capital, I would say. Now, as you move into the stage of where you've got customer acquisition, of course, you've still got personal funds and grants, but really you're then more, you are more focusing on credit. And can you hear me? It's telling me that I'm muted for some reason.
No, we hear you. I think it muted you for some reason, but I can hear you.
That's fine. Then you start to get into more options on the equity side, and we start to get more firmly into the angel investing, then the venture capital. And then as you get very big, you get into private equity, listings and other things, which I don't think we'll focus on today really, because it's probably, it's a whole nother level of financing and funding. And also debt then becomes increasingly easy to access and viable. And really, it's really interesting because you're even now starting to see more and more of this venture debt, where people are prepared to lend to early stage businesses, which they weren't doing before, but for additional interest rates, right? So if you think of a very big commercial company taking on debt at, I don't know, it depends. Let's call it 3 to 7%. 3 is pretty low, probably 4 to 7%, depending on what they're doing, depending on the bank and depending on the region. And then you look at venture debt, which is somewhere between 10 to 15%, right? So it's a lot more expensive, and that is a reflection of the risk. Nevertheless, if your business is growing very rapidly and you're confident you can factor that into your cost base, it's not a bad option. It's not a bad option because you retain control and you retain ownership. And the idea here is to maintain your ownership stake in your business for as long as possible. And if anybody's interested in talking about that, we can talk about that later, or we can talk about it subsequent to this, because the way in which you are able to maintain your stake in your business, if you are taking on equity early on, increases the optionality and the value of your business going forward. Future investors do not like businesses where the owners do not own a heavy stake in the business. And this all comes back to how business ready are you when you go into these conversations? What valuation can you secure for the meaning? The what dilution do you take? So how much of the business, how much ownership of the business do you have to give away? So just if we talk quickly about loans and equity, and then I'm going to focus on the equity side. To secure your loans, as I said before, lenders need to have income streams or other assets to secure against the loan amounts. You must meet the repayment requirements. You know, I've seen this happens even in very big businesses where people are not meeting the terms. The banks will foreclose. They will take the assets. In the event of the worst case scenario where you go out of business, lenders take priority. So they will get paid first in any kind of a liquidation where the assets are liquidated to return to the shareholders. Lending usually requires a track record and strong cash management evidence. And we'll get to this. This is why get a bank account and start auditing your accounts right from the very first day. Because when you come to want to use financing, it's that day one, and the earlier you do it, the earlier you can access additional financing. And as I said, it's difficult for early stage business. Beehive is an example in the UAE where you, in more early stage businesses, and this is a peer-to-peer lending situation, where the lenders have less recourse. The interest rates tend to be a little bit higher, which is why it's a good investment for them. But you still have to be vetted. It's not, you can't just, log on and say, hey, I've got an idea, please give me money. You still need to have a business plan and some other things. So lenders focus on return of money for a cost. The equity focus on return on money. Okay. This is more, there are more options. It's more flexible. The investor types range from the family friends. Often we would call it the 3 Fs, family, fools, and friends, because it's a high rate of failure, right? But that's okay. That's why you get in early, because if it works, you make more money. To angels, incubators, accelerators, which we're seeing a lot of, we're seeing an absolute explosion in this incubator accelerator activity in the region at the moment. Venture capital, private equity, public shareholders. I mean, I was just talking to somebody this morning, and I hope I'll find out more next week about one that's been launched with in conjunction with Aurora 50. Aurora 50 is an organization which is advocating and trying to increase the board readiness and number of women on boards in the UAE. And they may have just launched a new incubator accelerator. So they're happening all over the place. So this gives you rights to ownership and potentially future cash flows in the form of dividends. And they are the last paid in bankruptcy, including you, right? In the event your business goes out of business, the creditors get paid, which are the loans and other suppliers, employees, not you, employees, then the creditors, then the shareholders, whatever's left over. So just be aware of that. Okay, early stage investors. And what do they look for? So your first ones are your family and friends. We all ask for help. They are the first in usually, and that's not a bad place to start. However, it's good because it tends to be more easy. It's not as good because they tend to not ask you. They will not enforce upon you the same level of rigor or requirements as some of the others. You may think that's a good thing. It doesn't help you in the future, because the earlier you start doing these things, the better you get at it. The other thing is it can be complicated from a relationship perspective. So just be clear on why and how you're doing this. Then you have angel networks. And here you start to see the complexity. And I'll come back to investment clubs. Investment clubs are similar to angel networks. They differ slightly in the sense of people maybe a little bit less, they're just less complex sometimes, but I mean, they don't exist as much as we see in the region here. So really you're into angel networks like Dubai Angel Investors and others. Wayne was one that was set up by Heather Henyon. This is the Women's Angel Investing Network, first and only, I think, or first angel network for female investors in the region. And that was actually the precursor to Mindshift Capital. Then you have VC firms. These are more institutional. They take bigger tickets. They're later stage than the angels. And then you have your PE firms. And as you raise more and more capital, the complexity of the terms and the level of involvement increases. And there's a wide range. So in the VC world, you know, you have even now what they used to have seed, which was sort of the first money in after the angels. Now you have pre-seed. So it's sort of even earlier than early. And really that's got to do with where you are on the revenue generation and on the MVP. And then you have ones that sort of Series A or C plus Series A, and then ones that do later stage, so B, C, and D. And once you get into D, you're in a hybrid crossover into private equity. Private equity is more around where your business is large, stable, relatively stable, and the private equity firms will inject money for expansionary growth or restructuring of some description. They think they can bring some additional, it's usually you're buying up other players and integrating them, or, you know, really strongly going in and changing some operational elements of the business. Whereas VC is still businesses rapidly scaling. So how do we get investment ready? I don't know, Jen, just stop me if you want to ask some questions at any time. How do we get investment ready? You know, here it's before you do anything, let's please start with the basics. These might seem silly to even have to say, and I'm sure some of you who are well on your journey will not need any of this advice. But if you're thinking about starting a business or you're in the early stage, make sure you've done these things. Firstly, be clear on what you're doing and be bold with your vision. Well, be bold if what you think you want to do is have a unicorn, right? If what you're really saying is, I want to have a very nice, stable business, that I do something that I love and I'm very happy and I earn good money, but I don't need to conquer the world. Just be clear on that's what it is that you're going to do. Understand that building a business is a long-term game. You know, we see, oh, this person, you know, exited their business for X million dollars and now they're a superstar, multimillionaire or billionaire. That is never an overnight success. And before you do that, there is an incredible amount of hard work. And for every one person who does that, there are many, many, many who create nice, good, solid businesses, but don't become billionaires. Right? This is a long-term game. Clarify your commitment to this. This is hard work, right? And it's hard work to raise capital or to find investors too. Both is hard work to run your business. It's hard work to get the investors. And you need to be able to fund yourself for a period of time, okay? That's the only way you can build the track record and build the basic business so you can be investment ready. Be honest about your strengths and weaknesses. No one can do it all. So you might be the world's best marketing person, but you may not be a finance person. That's fine. That's absolutely fine. Just make sure that you're clear around where you need the help and be prepared to bring that in And honestly, be prepared to pay for it. In the first instances, it'll be beg, borrow, and steal. It always is. And you might do other things. You might do sort of, payment in kind or whatever. That's fine too. But at some point, accept the fact that you can't get everything for free. And now we get to the even more boring part, which is understand the market in which you're operating in. Understand the regulatory requirements. What licenses do you need? What permits do you need? What are the employment rules? And estimate your minimum cost base. Get a view on what this is going to cost you and make sure you can fund that. You need to establish a legal company. Do it properly. You need a dedicated bank account. Don't mix it with your personal finances. Keep it separate. Keep it clear. Understand your taxation requirements. This is increasingly becoming important in this region. I don't know how many people will have seen the news that's come out of Saudi recently with a number of large name successful or well-known startups, Fetcher, etc., who have just been hit with very significant VAT tax bills. Okay, now I don't know the details of that. It is true that the tax authorities across the region are becoming more and more vigilant and active in looking for potential. I don't want to use the word breaches, but I would say miscalculation or misreporting or anything like that. Now, 100 million is a lot of money for a business that still is funding itself from equity contributions. I mean, they have some cash flow, of course, but they're taking on new funding. So please don't find yourself in that situation. Work it out at the beginning and keep a buffer. Establish an invoicing and basic accounting system. There's a lot of these you can do online. They're not difficult. They link with your bank accounts. And what it means is you're having a paper trail. So when you get to the point where you're asking for other capital, you can produce this documentation very easily. In addition, it's good business practice. You will know what's going on with your business. If you don't do this, it just becomes much more of a headache, and running it on Excel is tempting, but these are here to help you. They can integrate the corporate credit card statements, they integrate your bank account, they send your print your invoices, you can issue your invoices. Don't shy away from online payments or anything that creates a paper trail is good for you. And this is where I talk about identify how to take payments. It can be a bit frightening, so please make sure you ask for help. But get the basics right, and you'll have done step number one. And I'm sure there are people here who are successful business owners who have dealt with all of these things and understand. And maybe in the beginning they didn't do some of them, or they certainly didn't want to have to do them, but they did it in the end, and now they're reaping the benefits of it. Before we get to the next stage, I'd just like to ask an open question. Why do you think it is that businesses fail? And I'm going to share with you some statistics in a moment around why startups, and this is a sort of a global feedback loop around looking at people who have started, probably taken angel and or VC money, and then they talk about why did the businesses fail. So I'd be interested, just open question, put it in the chat. Why do you think businesses fail?
So we've got lots of different answers coming up, from poor financial management, lack of financial literacy, absence of required resources, lots of people saying cash flow, lack of research and preparation, growing too fast and overselling, no market for what they do, not keeping up with market requirements, unable to raise money, unable to get a proper management team, bad organization and unclear vision, not understanding the true value proposition, lack of vision, inconsistency between vision and execution. A lot of people are suggesting financial management and understanding cash flow. We've got, a lot of different things are being covered here, Rebecca.
Okay, well, great. Well, it was certainly, I think we're all on the right track here. The top 20 reasons, and here I've just shown you the top 10 because actually you start to get things that are kind of repeating. First of all, the business was not a business. So when you talk to people about, and I've personally invested in a regional company here that was very successful, but has recently failed and has gone through liquidation. And when you, and I won't go into the details of it because it's confidential, but one of the things you hear from founders is, well, people wouldn't fund me. And what they mean is, well, I told my investors I needed more money and they didn't give me any more money. Not they wouldn't fund me in the beginning, but they funded me. And then when I needed more money, they wouldn't give me more money. The reality is if somebody's not giving you more money, it's because they don't believe in your business anymore. And so it all circles back to this point that says there wasn't enough market need, or something in the market changed that meant that the offer that you had, people no longer were prepared to put additional capital into it. So why I bring this up is before you go out and ask for capital, make sure you're very, very clear about what you're bringing to the market. It sounds basic, but it's not about having an idea. It's about testing it in the market, testing it with customers, getting their feedback, changing the way you do it, adapting to market conditions. I'm working with a business now which does it's an agri-tech company out of Asia Pacific, and they've been in the market, they've been working on the R&D and developing the product and testing it with customers, real live customers and partners for 3 or 4 years or even longer. And through that, the product has, the improvement in the productivity, the improvement in the outcomes, the improvement in the profitability is extraordinary. And so, yes, they have taken on some money, but now we are involved in a very large Series B raise. And without that, and people always say, what do the customers say? What do you sell them? Why do they buy it? Who's buying it? And they want to see it tested and they want to understand how it's improved. So this is really important. The second point you meant was cash. Cash is king, even in early stages. And this can be really, really hard. You're doing so many things at the same time, but you need cash to continue the business. So yes, cash management is a problem. And this is also a little bit, it comes back to my investors wouldn't fund me. Look, don't leave it till the last minute, because then people worry. How did this happen? How did we get to this situation? Surely you must have known that you needed more cash. So get on top of the cash right at the beginning. Make it easy for you to see where the cash is going, and how it's being managed, and your bank balances. And then you get into team. Team is critical. You certainly can't do it without the right team. But if you don't have a product and you don't have any cash, the team won't get you anywhere. So you need the first two, but you also need a great team. And you need to be able to work collectively to respond to what's happening in the market. And then thirdly, competition. So this is of course a situation. There can be a rapid change. Another business that I've been involved in, the market was a big gap. 2 very large players emerged in parallel to some they were large, very specific large. They were focused, they really drove the market and had sort of they were the leaders. And then there was a new entrant, which had a very, very wealthy backer, and they completely changed the profitability structure of the market. And in hindsight, you can see that you can see that people can say, well, that was always going to happen. It's not true. You couldn't have always seen that, but the early signs had been there. So watch your competition, understand what's going to happen, and understand what that's going to mean for your business in terms of keeping your options open and looking at opportunities potentially before they might arise. So for example, a sale of your business or other things. So, I think people were asking earlier, what are people looking for? And we can talk a little bit around timelines here as well, and returns. So early stage investors, and we'll focus mainly on angels here, not your family and friends. again, they're looking for a strong idea, which is solving a real problem. And when I say a real problem, the problem has to be big enough. Okay. It needs to be something that either a small is not the right word, but a focused market has a very big need for, or a very large market has a demonstrated need for. But the opportunity has to be sizable. And it has to be a real step change. You have to be solving something that someone's going to pay for. They look for the team. Team is critical. People invest in people, ideas and people, and they're the only things that, without the people, you can't execute the idea. They will look for a business plan. Now, you need a business plan really at all stages of your business. The question is the complexity of it. In early stage, it's very important to be concise and clear in your plan. What are you going to do and how are you going to do it? So it's the why. The why are you going to do it is what's the problem that you're solving. The what is both the idea, the concept, and then there's the how. How are you going to bring it to the market? It will also, then it will manifest itself in some sort of very high level financial projections. Although the earlier stage you are, the less people will focus on that from a financial projections perspective. What they will focus on is how you're going to use the funds. So you asked before around percentage distribution between sales and marketing and employees. Look, I prefer, and this is probably my management consulting background, to really think about this more around on a bottom-up perspective, and then you end up with the reality, because these change. It also changes on the start of your business. In early stages, it's going to be very heavy on people. As you get bigger, you'll start to see this internal people, employees. I mean, what else have you got? And maybe a bit of, you try not to have rent. You minimize all of the other costs. It's really about people and inputs, probably, raw materials of some description. And then as you mature, all of the other SG&A elements start to fill out, right? I mean, it depends a bit on what your business model is. How do you use a distributor, and where does that cost sit? I mean, if you're selling to a distributor, then how do you record your sales? Do you record them net of distribution fees, or what is it? So there can be an accounting thing here, but it changes over time. But you need to be able to say, I'm raising $10 and I need $10 and I'm going to spend 8 of them on people, and these people are going to do this. I'm going to spend 3 of them on raw materials. I'm going to spend 2 of them on marketing and business development. And sometimes your marketing and business development is rolled into your people anyway, because you've got people who are doing it. So it's just that you have to be really clear on what your use of funds is and how that will mean you can execute what you said you're going to do in the business plan. They also have to have a view that there are exit options, because at the end of the day, they want to get their money out. They're investing to make money. And that only happens if they get the cash back. This is around more high level than a real exit plan. And I'll talk to you about how that differs. Once you get to the next stage from the angels, you get into the venture capital world, and people get a little bit more specific around what they're looking for. They want a proven market fit. You need to have a track record of delivering this to users. People need to be actively using. You need to have growth, okay? And what they want to see is rapid growth, and that there is an ability for you to rapidly grow into the future. You need to be very clear on your differentiation for competition. You also need to be clear in the angel, but here you have to be extra, because there will be other people doing what you're doing. It's rare that there's nobody in the space at all. And in fact, if somebody says to me there's no competition, well, I just don't believe them. It might not look like the same. It might not be exactly the same, but it might be a substitute. It might be a poor substitute in your opinion, but people may still be using it in some other way. Of course, there are cases where you are fully disrupting an industry, and that's wonderful. But then really what you're saying is my competition is things that don't look like me and no longer serve my purpose. And that's why I am so differentiated. And people call this your moat. So what is it that protects you from competition eating your cake. This can be anything. It can be the people in your team. It can be intellectual property on your technology. It could be a unique distribution. It can be a range of different things, but it has to be somehow sustainable for a period that's long enough for you to move, to grow your business. It could be the scale of your business. In the end, scale becomes a moat. So it can be a range of different things, but you need to be very clear on it. Team, critical, as always. It doesn't go away. People still invest in people. And this is the same. I mean, even if you look at a listed company, the CEO, the CFO, the board, other key people are all critical to maintaining the value that people ascribe to those shares. You need a business plan with financial projections. The more money you're asking for, the more detailed you need to be on this. And this is a fully fledged, usually it's fairly fully fledged by the time, not if you're at seed stage, but by the time you're at Series B, Series A and Series B, then you need to have a reasonable view on this. And here you need not just options, but a bit more of a plan. Now, no investor will expect you to know exactly what will happen, and they will hold you to that. Absolutely not. But it looks like things like, we believe there are 3 options. We could sell to, it could be a trade sale. These are the types of people who we know are interested and blah, 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 blah. It could be, we expect to list on a secondary market, and we believe that we would have the right, financial makeup in the next 3 years. And by the way, then they also want to know that you've got, when they get into the next stage, in the diligence stage, they start to test your ability to execute on that by looking at things like your financial reporting, your management, how systematic you are about running your business, because getting ready for a listing takes at least a year. You'd be surprised to meet the requirements. You need to be thinking about that in advance. That's probably well beyond this conversation, but it's very important. So I know that we've probably got lots of questions. So I will just round out the last couple of pages, and then let's have a bit more of a chat. So, okay, you're now at a situation where you're thinking, I think I'm investment ready. I've got my financials in shape. I've got my story. I've got my team. I've got my legal entity set up. I've protected I understand what my moat is and all the rest of it. I know why I need funding. I understand how I'm going to use the funding, and I've got a point of view on the type of funding that I want. Now, what do I do? What's the process? Now, it differs slightly for debt. In the debt situation, it is much, much more financial reporting and legal. It's not more, but that's their focus. You need your audited accounts, you need your projections, you need your management accounts, you need all the legal elements, all your articles of association, everything like that. You need to declare your current liabilities. You need to declare any legal cases and other things that are going on. You've got to meet KYC requirements, all of these sorts of things. That's really on the debt side. And you have to show that you can service the debt at the end of the day. On the equity side, at some point, many of those questions are the same ones. So it's not necessarily different material, but it is a slightly different, the concept is different. So in order to get on the road to attract equity investors, you need to have a pitch. This word, I think, is overused in some cases, but it's a reality. It's your elevator pitch. Who are you? What are you doing this for? Why did you start this? How are you going to win? Why would I invest in your business? What are you going to do with the funds? Okay, and how do I get out? That's essentially what you need to have in your mind in order to pitch your business. Now, depending on the forum, that's more or less developed. But if you're I was at an event here last night in Saudi, and really what's happening is you've got 30 seconds to tell somebody what it is you do and make yourself interesting to them to consider you as an investment. And really all you're trying to do is to get to the next conversation. And the next conversation is one of two things, or maybe both: a more detailed pitch or presentation of your business, and sharing of a teaser. Now, teasers can come in different forms in terms of style, and I don't think there's any one style. I come from a more detailed, consulting orientated background. I like more detail. Some people really like very high concepts, but in reality, what this must contain, in a way that, in a style that suits you, it's your style, it's your business, you need to say who you are and who is your team. What is the problem that you're solving? And this links actually to the one below the solution, the market size and dynamics. What is the problem and how big is it? What is your solution? Why are you better than others? Why will you win or be one of the winners? And the high level financial opportunity. That's it. Okay. That's really what your teaser is. And after you've had an opportunity to, usually you send this out, you might be in pitch events, you might have one-on-one meetings or calls, as we're doing now. It's a range of different interactions with investors, and there's no one way. But really, once you're doing this, and then you're getting into detailed information review and diligence, you need the teaser, your financial statements, you need your business plan, financial projections, you need key management. They often look at contractual, for the key management, have you got a contract in place? How are they incentivized? Do they own parts of the business? Who are your customers? Do you have any references, and how are you going to grow that customer base? And usually they will do a check on the legals as well to make sure that there's not any, or they'll ask you to declare that there's no pending legal liabilities. And these are the things you need to be ready with. I'm just trying to, there was something that came to mind, but these are the main ones that during that process you have to be prepared for, and better to be ready in the beginning than at the end. And the key here is get to the no fast. Okay, it's not getting to the yes. The full yes will take time, and what you don't want to do is waste your time with people who are not interested, or it doesn't fit for them, and that's fine, right? The number of people who will tell you no before somebody tells you yes can be very soul destroying, but keep it up. You get better at pitching, you understand what investors are looking for more, you hone the way you tell your story, and most importantly, you build a network, because those people that say no in the beginning can come back later as investors. It's an interesting thing. I was taking part in a forum, slightly different, but it was about first-time fund managers, and one of the things that people who'd successfully move past this stage has said that we actually keep very, very close tabs on the people who've said no to us in the beginning. They are easier to convert in the future than cold calls, than people that don't know our story. So people can often say, and we do this at Mindshift because we don't invest in very early stage companies, but we will watch you. So we will stay in contact. We're happy to, hear what you're doing, help if we can. And when you fit into the right segment for us, that is a great way for us to fast track an investment, because we know you. We've seen you develop, we've seen you build your business, we understand you, so the trust is there. So don't be afraid to talk to a lot of people and get a lot of no's. And lastly, just as we're heading in towards the end, what's the approach? So you've done your work, you're investment ready, you've got your documentation ready, and you're ready for the process. What do you do? So here it's all about getting to that no, or getting it to the yes. So you approach investors, you do an initial pitch. They will do their screening, and usually this is very high level. Do we invest in the region, the size, the product segment? I don't know. They will have a set of criteria. And the idea for the investors is also to get to the quick no, out. Okay. Once we think you're a maybe, or a possibility, or a potential yes, I think I should say, you'll go through diligence. And this is not to, the purpose of the diligence is, again, to validate that you are a good investment. The screening is trying to weed out the ones that are not. So what we hope we don't see, we hope we don't find bad things in the diligence. right? We're not doing this because it's necessarily fun. We're doing this to check that our instinct and our view that the business is a good one is correct. Then you get into negotiations around the terms. You issue the term sheet, finalize all the legals, you close it out, and then you transition, the investment's made. Be prepared for the transition. And in this negotiation term sheet phase, here you will also talk about investor rights. So you need to be prepared for that. It usually requires some sort of reporting going forward, and it can require some other things, options in future investment rounds, which I won't go into. Now, if you're in a situation where you're selling your business, or you're selling a majority of your business, and you will be transitioning into a role, you may be staying as the CEO or the general manager or whatever the title is for a period of time. But at some point, be prepared for this transition. You will no longer be the one who makes all of the decisions. You will more and more become an advisor, but often you also have an earn-out period. So it's usual, depending on who the buyer is or the investor, that they will agree to a price of your business based on your business plan and your perspective that the future revenues and future income streams will be there, and they will then phase the payment on the delivery of that. So be prepared for this. It's not usually a one-time, I get the money and I'm out. And if that is, then usually you take a trade-off on that. And so be prepared for what that means, because you will no longer be, unfortunately, the sole boss. And that can be tricky. It can also be wonderful, and it can be the perfect transition, but be ready. So those are all that's the end, Jen. So if people wanted to, more questions, we've got a little bit of time. Anything?
Yes, so I have a number of questions that we've listed down. So I'll just run through them. One is, a few people have asked this, that they've said that they have bricks and mortar businesses, and very successful bricks and mortar businesses that are profitable, and they've grown organically and reinvested the profits in their business, but that they have exciting projects that they need a cash flow runway for. She wants to know, is there a possibility, are investors interested in bricks and mortar businesses, or is the interest really with e-commerce businesses, and would she have a chance of being able to get investment in her business?
Yeah, why not? I mean, the world is not, I think we can get carried away a little bit on the whole tech thing, right? The reality is all the other businesses are still there. They provide nice cash flows, good profitability, good returns, but the investors are different. So don't go to a venture capital fund if you have a bricks and mortar business. It's just not the right place to ask for, but that's fine. So I think there are plenty of people, particularly in the region, family offices, these sorts of things, who love, I don't know what sort of a business it is, but who love investing in these kind of businesses and put them in their portfolio. So yeah, sure, why not?
Excellent. How do we find impact investors in the region?
Well, I think it depends. Look, there's an increasing number of them. It depends a little bit on what your view is of impact investing. I mean, the impact investing today, and it also depends on the size of your business and all these sorts of things. There are a number of people who are increasingly interested in impact investing. I am involved in a fund called Conscious Collective, that is an impact fund based in the region. They invest globally, but it was founded in Dubai. And this is really about investments that have both impact in terms of solving the sustainability goals, but that also return financial metrics. So there is another type of investing which is more social impact investing, and this tends to weight more heavily on the social side. But again, it's a continuum. So they're around. I mean, I think it's difficult to. There's no one source for this because it's still emerging. So again, I mean, I hear, you know, there are a lot of forums and webinars at the moment that have been run, you can all over the place around impact investing. What I would do is I would start to register for those, get to see who's on those panels, and then reach out to them. That would be what I would do.
Okay. And we've been asked by a few people wanting to know if where they can find out the details of these things, of these people. Are they promoted anywhere specific?
Not in one resource, honestly. I mean, look, LinkedIn's really good. If you look at all the government investment agencies, the free zones, so ADGM, DIFC, but honestly, I think if you look on LinkedIn or you do a Google search, you'll start to see them. And then once you find one and you connect into the network, you'll start to see the rest of them.
Great.
I see that. I mean, I get a lot of them because of my where I am on LinkedIn and these sorts of things. But yeah, the ADGMs, the DIFCs, the ADIOs, ADA Investment Office, and then there are some people. So if you look up Conscious Collective, Sonia Waymiller, for example, she hosts a number of these things, and so therefore you get a lot of the other people in there.
And a number of people have asked as well if you could share a couple of names of angel investment networks. Excuse me.
Sure. So Dubai Angels is a good one. I think there's also Saudi Angels. There is I'm just trying to think off the top of my head. Those are the two. I mean, those are the two. Again, I would just look up here. I would, look at the UAE Angels Network. There is a forum that was just started yesterday, actually, called the World Angels Business Network. I think it's been launched. It's being held in Dubai. They're a great one. I work with a woman, Marsha Darwood, but this is not in the region. This is she's the chairperson of the Angel Capital Network in the US. So there are these networks across the world. And through that, you can see all of the regional ones. They come and go a wee bit. There's lots of them popping up.
Yeah, great. And a few people have asked as well about equity for early stage investors. How do they decide how much equity they should part with?
This comes back to, you've got to value your business in some way, shape, or form, guys.
Yeah.
It's not a rule of thumb. It's like when people say to you, how do you value goodwill? You don't actually value goodwill. Goodwill is the belief. Goodwill can be an accounting term that sits on your balance sheet, and that's got to do with the premium that's paid at a transaction. But let's boil back before you've done that. How do you get that? It's not, you don't add a premium. You don't say, well, 20% goodwill. Goodwill is the excess that people are prepared to pay because they think that you are going to earn that money in the future. So this is all about the opportunity and what you're willing to give up and what the investor is willing to accept. It's very difficult, but try not to give up too much. So that's why do as much work as you can. And there are various methodologies that you can use to get an idea. In addition, there are some kind of rules. So, multiples of revenue, these sorts of things. And then you do a valuation and you work out how much money is coming in and what's the pre and the post number. And that will give you the percentage.
Okay. Other question as well about, do investors have a preference for sole founders or co-founders? Is there any rule of thumb for that?
Yeah, it's an interesting question. I think usually sole founders, the key man risk is really, really high, right? So that just adds a bit to the risk. And then they will look at, okay, who else is in the team? How incentivized are they? How committed are they? What's their track record of working together? These sorts of things. How long has the founder been running the business for? This kind of stuff. So co-founding teams are, and they also have advantages. You bring more connections to the table. You can share the load, but then you have a problem because maybe they don't get along in the future. So neither are 100% good or bad. There's another argument about people who end up in running businesses with spouses. That is something that people often find concerning. But it's also not, none of these are showstoppers.
Okay. Okay, great. We agreed that we're going to finish at 12, so I'm just going to take a couple of more questions. And then if anybody else has other questions, I think you said the best way is for them to reach out to you on LinkedIn. Would that be the best way?
Yeah, I think so, yeah.
Okay, great. What types of equity agreements are there that can be set up with investors, and who dictates the terms?
So things have been moved along a lot now. There are a lot of standard frameworks now that have been issued by some of the very big angels and investors and people who have successfully taken investment on. So two of the most common ones are what's called a SAFE note and what's called a KISS, KISS and SAFE. Both of these are standard. You can find them on the internet. Other places like Clara, and legal firms, and also Y Combinator and these kind of places make them available. They tend to be convertible note mechanisms for early stage investing. And then sometimes you just have a really standard shareholders agreement. Again, it comes back a little bit to what you think is the optimal solution for your business in a situation where you think you're gonna go on and look for venture capital, etc. Then typically these kind of convertible notes are usually used. If it's a more stable business where you are, one of the ones that you were talking about before around taking some cash runway for new projects, you might just simply go for a new shareholders agreement.
Okay. Okay, excellent. Now, we're going to wrap this up in a second, but I have two questions that are kind of linked. And it goes around women and funding. And I know that you and Heather do a lot in this area. One person asked, how do we get past the psychological barriers to ask for funds? Do you have any thoughts on that?
Get over it. There is no magic sauce in this, right? Prepare yourself, practice, find a friend, test it with people who you feel comfortable with, and then just do it. I mean, some people are great networkers. Some people are great. They have, some other people are not. But the world belongs to those that do. So you just have to do it. I'm sorry, but prepare yourself.
Yeah. And the worst,
the more you do it, the less worried you'll be about it. The more you realize that just because somebody said no, it's absolutely no reflection on you. I mean, it might be a reflection on the way you ask for the money, and you can learn from that, but don't take it personally. This is not, don't take it personally. It's hard, but just.
Absolutely. Now, last question. I would love to hear your thoughts on this, and it's an ongoing discussion. We hear a lot about women founders not receiving investments. Is this changing?
Yes and no. I am an eternal optimist. Okay, so I believe that the opportunity is there for our taking, and that's the reason why we do Mindshift, because we know that there are many more extraordinary female founders out there than there is capital going to them. They are not getting their fair share. And actually that's sad for everybody. It's sad for the founders, it's sad for their employees and their markets, and it's sad for investors, because they are a good bet. Not everybody, like not every guy is a good bet. Like it's not about gender in all areas of the spectrum. It's not about gender. If you look at the numbers, total absolute investment going into women is growing. Share of total investment was kind of stagnating, which is a bit sad. But the onus is on all of us to do that. One is more women need to get out there and ask for money more and more. Now, pipeline's not a problem. I was asked last night, do you have a pipeline problem? Do you have a problem with sourcing? No, we have many more deals than we can fund, many more good deals than we can fund. But get into the market, ask for the money. The second thing that we need to do, and I really believe in this, I think the problem sits at this side. We need more women investors. And that is really the thing that I'm very passionate about at Mindshift, is growing the amount of money that we have to invest. The statistics show that female investors invest more in women than male investors. I don't know, I don't want to go into the psychology of it and all get too deep on it, but it's probably partly our networks. It's probably the way we communicate. It is also definitely the products in some cases. You know, there's a company called Clue. I don't know if anybody's using it, but it's a fertility app. And when the number of no's, no, the people that she was pitching to were just like, why would anybody use that? Why would anybody pay for that? And it's a extraordinary success. You're now seeing, and this leads to the massive boom. There's been some recent discussions around the amount of money now going into what they're calling femtech, but let's call it women's wellness. Now, everybody benefits from having well women in the community, right? It's not just women. I mean, their whole families, the community. We talk about the economic contribution. You talk about all of this stuff. We need a well society that includes men, women, old people, young people, whatever, of all diverse races, genders, whatever. You can't deny that there are needs that are unique to women that are underserved. So, but you need investors who can identify with that. So you need to have more women investors. This is my passion, to get more women putting their money on the table in an informal manner through angels, and even, I think most importantly, we have to change the tables at the institutional level to get the funds flowing there. So that's my view.
Absolutely. Oh, thank you very much, Rebecca. Would you mind just moving the slide on quickly? Sure. Before we log off, I would be really grateful if everybody would fill in the poll for today. There's 2 poll questions, standard ones that we ask as part of the UN Women NAMA Women Advancement Establishment workshops, because it's really important that we get this feedback from you so we're able to go and find out what you need, what you're looking for, if we're giving you the right content. So it would be super if you could take just 10 seconds and fill this in for us. It would be wonderful. You're getting lots and lots of love, Rebecca. Everybody's saying the best 1.5 hours that they've spent in a long time, giving them lots of insights and directions for next steps. So it's really wonderful that you were able to share your insight with us today. And you know, you've been on my top list of people that I wanted to bring in to talk to everybody from UN Women and NAMA Women Advancement Establishment. So I'm so grateful that we could get 90 minutes of your time today. And thank you so much for your insight. And I would also like to thank everybody for taking the time to spend with us today and be really engaged, and also to NAMA and to UN Women for making today possible. And always, when we work together, when we support each other as women, we are always stronger together. So thank you so much, everybody, for today.
Thank you very much.
Thanks. Bye.